Dr. Kirk Elliott just completed a new interview. Rather than focusing on headlines, I want to walk through the key highlights and explain how to think about them through the silver forecast thesis. This isn't about reacting in the moment. It's about understanding what actually matters underneath the market. Dr. Elliott starts with a simple investor question. Why would you not allocate capital to the most important commodity in the world? Not the most popular, not the most talked about, the one the world actually needs. His point is straightforward. Allocating into what the global system depends on is how you minimize risk while still positioning for asymmetric return. That framing fits directly with the silver forecast thesis. Silver isn't moving because of excitement. It's moving because it's becoming structurally necessary. One of the most important confirmations he discusses is what just happened at the government level. 2 days ago, the U.S. Department of Defense committed $2 billion to a silver smelting facility. Total projected cost, $7 billion. This is what it looks like when silver is no longer treated as just another commodity and starts being treated as a critical material. This isn't a price signal, it's a structural one, and it's happening on top of an already existing global silver shortage. That matters. Performance puts this move in perspective. Last year, gold rose 65%. That's a good year. Silver rose 147%. That's not speculation. That's repricing. And Dr. Elliott makes an important clarification. Silver is not overheated yet. Not structurally. Not historically. At some point, silver will overheat. When that happens, gold will take the lead again. That's when reallocation begins. But that moment is not now. This isn't theoretical for him. Dr. Elliott has used this strategy for years. Allow silver to lead while it is under-owned and structurally constrained. Then once silver becomes overheated, reallocate into gold. Not by guessing, not by emotion, by structure. That approach aligns perfectly with the silver forecast framework. We don't chase price, we follow structure. He also makes an observation that helps explain why this move still feels confusing to so many people. Without suppression, gold could already be trading near $12,000 an ounce, silver near $1,100. Whether you agree with those exact numbers or not, the takeaway is simple. Current prices do not reflect true scarcity. That disconnect is why volatility feels violent and why confidence breaks before structure does. Here is Dr. Elliott.
Important for everybody to know, how do you minimize risk and maximize return in your portfolio? You allocate into the commodity that the whole world needs, right? Because that's going to be built-in demand. All these firms need silver. All these industries need silver. You know who else says that silver is important? The Department of War, right? So what Trump's Department of War did 2 days ago is they committed to spending $2 billion on a silver smeltering plant. So, and now the total cost is going to be like $7 billion. So this is kind of in response to the silver being put on the critical minerals list, right? It's like, okay, what are they doing? What are they saying? They're saying that this is so important, we need to control the production, we need to control the distribution, which is why gold and silver leaving London, why they don't want silver in China, why China is no longer exporting to the rest of the world, why Trump is tariffing these countries. They say it's so important. Not only did they put it on the critical materials list, they also are opening up a smeltering plant in America. Would we not, as investors, want to invest in the most important commodity in the world? Of course you would. That's how you minimize your risk and maximize your return. Now we're seeing the supply shortages, which aren't going away anytime soon. Again, Alex, it takes over a decade to open up a new mine. You look at silver and gold, neither one of them are bad. Right? They're both fantastic. Gold was up 65% last year, silver up 147%. So when I look at that, silver is more than doubling the rate of growth of gold, more than doubling. And that's going to continue on for a bit. But ultimately, it's like, hey, if it doubles the rate of growth of gold, and it's been doing that for a while, what do? We sell it and we take those profits, roll it into gold. What did I just do? I got you almost twice as many ounces of gold then as what I could have purchased for you on day one.
Sure, but why not just keep putting it in silver? Because like you said, you do the ratio. How much more is silver undervalued for what it should be? It
should be thousands of dollars an ounce, literally.
Sure, but the ratio of what gold is undervalued versus silver, isn't it like 15 to 1 or something?
Yeah. So 3 months ago, it was about 90 to 1. Now it's at 56 to 1. It's like, oh, good grief. Historically, we're going to get down to 30 to 1, meaning it takes 30 ounces of silver to buy 1 ounce of gold. So as we approach that ratio, at some point, you are going to bottom out. Silver slows its growth, it just gets overheated, and then you go into gold as the ratio goes in the other direction. Now, why would you go into gold? Nothing goes up forever.
Industrially, you're the expert. There's such over demand and lack of ability to mine it. I don't see it stalling, actually.
Yeah, I mean, look at silver should be $1,124 an ounce. Gold should be $12,631.
Sure, what I'm saying is all the new sciences all the new technology only wants silver more. So even all the industries admit it's only getting more insane. You predict the Pentagon would move into the actual mining and smelting. Now that's happening. I don't even see how that happens, because they got to have it for all the computers.
They have to, and they're running out. This is where the price goes astronomical through the ceiling. So people may not want to actually roll into gold, but most of my clients are going to say, you know what? I want to take this overheated asset and go into gold, let it overheat for a while. Then you can go back.
So it'd probably be smart to hedge your bet then, to do a partial conversion to gold.
Yeah, because the ratios go from time to time. They both grow. Like from the early 2000s, I was in gold. From 07 to 11, I was in silver. From 11 to 20, we're in gold. From 20 until now, we're in silver. Because there's times when they go faster than the other. We just want to be in the right place at the right time. This is what I will help people do. And now that central banks across the world, Alex, gold has overtaken the US dollar. It's overtaken everything as the #1 held asset by central banks. I mean, the time for tangible assets is now, because people have lost trust and confidence in everything. Where we are.
There's one more important piece. In my most recent Silver Forecast Weekly Journal, I went live and walked through exactly what to do once silver reaches a new price reality. Not how to trade it, not how to call it top, but how to think about diversification after success, managing risk without selling the core position, and avoiding the mistakes people make when a thesis actually works. That discussion matters because of what we're seeing now. I'll link that weekly journal below. This isn't about excitement. It's about preparation. Structure first, allocation first, emotion last. That's Silver Forecast.